What's going on, guys? Welcome back to the channel. My name is Travis Sickle, and in this video, I want to talk about why I think the SEP IRA is an obsolete retirement plan and why you might want to look at a solo 401k. So if you don't know, the SEP IRA, you can contribute up to 20% if you're a sole proprietor or Schedule C filer, and up to 25% if you're an S corporation or an S filer. Now, the reason for that difference is because of the 1/2 of self-employment tax that you need to subtract and some other math, and that's why you have a reduced amount on the Schedule C side. But the thing I want to go over is comparing the SEP IRA to the solo 401k and why you might want to make that change. So the first thing we're going to talk about is the math. The second thing I'm going to talk about are the changes, or the recent changes, actually not so recent anymore. And last, when you should still use a SEP IRA, because it's not entirely obsolete, but it's getting there. So let's go ahead and start with the math and comparing the SEP IRA to the solo 401k. So let's go ahead and compare these two. So we have the SEP IRA, and let's say that we're earning $100,000 as a sole proprietor or Schedule C filer. So in order to do this math, if our net profit is $100,000, we have to subtract 1/2 of our self-employment, which is $7,065, and that leaves us with $92,935. But from there is our maximum contribution of 20%, which makes it $18,587. And that is it. It is 100% employer-funded plan based on your compensation. And in this instance, our compensation is the $92,935. So that's why we have to multiply it by the 20%. Now, if we use the solo 401k and switch our business by making a small change and filing as an S corporation, it's going to completely change your retirement plan and also your taxable situation. So if we run that math and we use the solo 401k, we're going to have a salary, and we're also going to have our distributions. So with a S corporation, you have to pay yourself a reasonable wage. So in this instance, we're going to split up that $100,000 to pay ourselves as a W-2 employee of our company at $50,000, and then we're going to take the rest as a distribution. Now, the benefit on the salary is that we only have to pay our self-employment tax on the amount that we're paying ourselves as a salary, whereas for the distribution, that is a distribution, so it avoids the self-employment tax. Now, you'll still have to pay federal income tax on that $50,000, but it will not be subject to self-employment tax. So not only that, we can also multiply the $50,000 by 25%. So that $50,000 for our salary at 25% would equal $12,500 that we can contribute as an employer contribution to the solo 401k. That also means we can make the maximum contribution of a solo 401k or a 401k up to $19,500. So that means we can add these two numbers up and get $19,500 plus our $12,500. That brings the total amount to $32,000. But that's not even the only thing that you can contribute. You can also make non-deductible contributions if your plan allows it, up to the maximum amount of $58,000, which means that we can contribute an additional $26,000, bringing it to the full $58,000 contribution into our retirement plan. And if you want, you can convert that $26,000 over to the Roth side, which is not something that the SEP IRA has. You can only make pre-tax contributions into the SEP IRA, so you wouldn't have a Roth option with the SEP IRA as you would with the solo 401k. Now, the math between the SEP and the solo 401k hasn't changed, but the change that happened with the Secure Act of 2019 is it allows us to now open open and fund a solo 401k up until our tax filing deadline, including extensions, which is the same with the SEP IRA. And for small business owners that didn't really know where their income was going to be until they did their taxes, and a lot of small business owners wait until the tax filing deadline, including extensions. So now you can look at your retirement plan and look at your taxable situation and then make that decision while you're filing your taxes, including those extensions. So number one, we're able to reduce our self-employment tax by changing from a Schedule C filer over to an S corporation. Number two, we're able to reduce our federal income tax by putting even more money in pre-tax into our retirement plan. And number three, in the example that I showed you, we're able to save over 3 times the amount. And number four, now we have Roth IRA dollars, so that means tax-free growth and tax-free income in retirement. Now, there is still one reason why you still might want to use the SEP IRA, and that's if you have employees. Because with the solo 401k, you can only include your spouse, but once you have employees, you're no longer eligible for the solo 401k. But if you do have employees with the SEP IRA, you have to contribute the same amount to those employees as a percentage that you would with your own plan. Now, if you're still leaning towards the SEP IRA, let me know in the comments down below, because I'd be interested to hear more of why you want to stick with the SEP IRA versus the solo 401k. And if you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.